about silver. It's kind of hard to look at silver and remain unemotional. Silver, gold, kind of the safe haven type things, but they aren't so safe anymore because they've gotten rather risky over time. And you can see I put the line on the bottom there where you can kind of say, well, this is the lower support line if you have it that way, which has now become kind of the upper support or the upper resistance area that could dampen any prospects of a rally. In this particular case, when you look at silver, if you have followed the market very much, you know that a full-size contract, 5,000 ounces, is a pretty high-risk type situation, and probably is not the type of market that people are going to be trading, unless they have a fairly deep pockets or unless they have some way to trade it. In this situation, everybody thinks, well, based upon the whole world, economy and the weaker dollar, silver has to rally, so everybody's waiting for that rebound. Everybody's looking at some kind of line, and they like to buy the breakout when it moves above that line. But where is the breakout, and when is that going to occur? It's very volatile, very risky for the full-size contract. I put the mini silver up here, the one that's traded at COMEX, mini silver, and to show you a thing about this that might maybe discourage you from trading this particular contract is there is the volume on a given day, and you can see that the volume is below 500 contracts, and on some days virtually nothing, and the most is 2,000 or 3,000. So the mini silver contract probably does not have the volume that's going to be sufficient for the average traders. One of the considerations you have to take into account before you start looking at what markets you're going to be trading. So if we look at silver, we're going to say that silver probably is not going to be on our plate as a candidate for a breakout type trading situation because of the volatility and lack of volume. Somewhat similar in copper in that the market has made a big breakout. It kind of got down below $4, went back up. It kind of then went right in concert with what was going on in the stock market. When you had the August plunge in stocks, you had the plunge in the copper market. It rallied a bit, got back up to this little peak. Then it came down through this breakout point here, this line here that had been the previous low, and broke down through and has since dropped all the way down to the $3 level. Considerably different change in situation. Again, now when I talk about what are candidates for breakouts and what might we trade in this particular case, it's a very expensive one to trade in that it's $250 a cent. And so if you have a 10-cent move, $2,500, and the average daily range recently has been around 10 cents, that's a pretty high risk type of a contract to trade. So as much as we might like to look at copper as a kind of the whole indication of the global economic situation, you have to kind of consider that maybe this is not a candidate because of what is required in terms of the amount of margin or performance bond that you would have to put up, and maybe too rich for most people's blood. And again, on a big picture type of situation, I'm looking at 10-year Treasury notes. Nobody knows. I mentioned the quote about the whole market situation where some political system is determining a lot that goes on in the currency markets, it goes on in the financial markets, the stocks, the interest rates, and so it's kind of become, at least in my mind, is diminished interest in trying to attempt to catch the movements in Treasury notes or any of the Treasuries, Treasury bonds, so forth, simply because too much political, too much government, too much control of those kinds of things that they are trying to maintain. And so the question here is, how much potential is it for it to go higher? Well, everything you hear suggests that interest rates need to go higher over time because they're almost at zero right now in U.S. Treasuries. And it's a reverse situation here. As the notes go higher, then interest rates go lower. And if we're talking about higher interest rates, then the notes should go lower, notes and bonds. We don't know whether that's going to happen. Again, it's pretty much up to the politicians that are going to do that. If we look at a chart standpoint, we have a couple of situations here we might be able to note. We see that we kind of have what you call what I would call anyway, the kind of cup and saucer type of a formation here initially. You have this kind of a saucer bottom, you have the cup, right here. You have the handle right here, the cup and handle bottom, and move up, but it failed. You can pay almost no attention in this case here, though, to these little gaps here, because those are this is a continuous contract, and it shows the difference, from 1 month to the next, one change to the next, which can be a little misleading. But the cup and handle is a nice formation sometimes to follow. When you look at another possibility here of a cup and handle that we could, possibly call the cup and handle situation would be this one right here, where we look at it as the possibility here of the cup and the handle, and then the market did break up and move above it. Breakout type of a situation with that particular type of chart pattern. I mentioned these chart patterns and these previous highs and lows, not because necessarily that's what you are going to trade specifically, but because so many different traders look at it. Those are kind of key points. If they see that and react to the chart pattern, the traditional chart patterns that are there, it helps the case that you are trying to make for whatever type of pattern that you are trying to follow. And so you need to be aware of everything that's available to the, from the chart standpoint to the other traders as to how they're looking at the markets. Well, now let's go back here a little bit, because we need to get into more detail and talk a little bit more precisely about how we would like to trade a particular situation, and just go back down to only the last couple of months of time. As I say, you have the reference here, the frame of reference where the previous channel has been and the breakout has been, but we're going to cut back our time frame here so we can get into more detail to just 2 months, and then we're going to turn back our time situation back here a little bit to about we'll say August, September, something like that from a time standpoint, because it represents the move both to the upside and to the downside and how they started. And we'll also talk about the current situation in a minute. We're going to then refer to the vantage point charts, or indicators rather, as to how to look at them and how to use them as a decision-making tool, not getting guarantees or anything like that, but looking at how to react to a market move based upon what we are shown by the vantage point indicators. The first indicator that we have here is the predicted exponential moving average. It's a medium-term exponential moving average that we are using. The medium-term exponential moving average is a 4-day exponential moving average of typical prices that is compared against a 10-day simple moving average of the close. If you're familiar with moving average type of trading and developing strategies, you know that the angle in the moving average is important, as well as the crossover type of situations that you have here. That kind of